All right, welcome back to the channel. This conversation today is one that I've been having for quite a few years now, and it's important for people to really understand the different benefits and characteristics that different types of savings accounts can provide for you. Before we get started, remember to subscribe to this channel so you can get more information every time I put new content out. Like it if I earn your like, dislike it if you want to dislike it, and comment down below. I mean, let's start a conversation about this stuff. I have already started to engage with some of you, and I appreciate that. And yes, I will be going back into some of the requests that you've provided with me to do an analysis of your existing life insurance plans. Are you being ripped off? Did your agent try to basically make too big of a commission and not maximize the efficiencies? I'm going to do some more of that for you guys coming up soon. So let's talk about the different types of savings accounts and some important considerations that you need for each type of account. And let me get my fancy little pen. So over here, we've got important considerations that you need to follow, and then the benefits of each type of account. So we're going to start with our traditional cash account that you would have on deposit at the bank. And here's what we know. The interest rates tend to be relatively low. Obviously, interest rates are going up, but these are slow to catch up to the rising interest rates. They're called demand accounts or direct deposit accounts at the bank. They're good in terms of relative interest rates right now, but compared to other types of rates, they tend to be relatively low. Interest, when you earn interest, you get a tax form at the end of every year from the government, a 1099 interest form, and you have to pay ordinary income tax on the interest that you earn. If you have money at the bank in a cash account deposited, and you went back to that bank and asked for a loan, those loans must still be negotiated with the bank with no guarantee or assurance that the bank is going to loan you money. In fact, if we know anything, we know that banks only loan money to people that have solid tax returns, solid personal financial statements, solid liquidity statements. Really, they loan money to people that don't need the money. If you are low on income, low on savings, low on cash, they're not going to loan you money because they view you as a credit risk, okay? So they will not loan you money. You will have to take money out of your account. Typically, when they do provide those loans, there's call provisions, which means at any given point in time, if they want to close that loan out, they can call it back. These accounts are subject to creditors if you get into a creditor situation. And then the liquidity from the loans is not assured unless a credit line is previously negotiated. So liquidity is an issue, right? When you use these accounts or try to use these accounts as collateral. And if we look at all of the different benefits, the cash account has some tax-free distributions. You can put in as much money as you want, potentially collateral available, safe, they're not going to lose money, and you have liquidity, use, and control. Okay, so those are the cash accounts. Now let's move on to what you might consider a CD. And let's look at the characteristics of the CD. Interest rates are better than the cash accounts, but still relatively low. Still paying ordinary income tax on the interest that's earned. Loans still must be negotiated, call provisions. Accounts are still subject to creditors. The liquidity from the loans is not guaranteed. And the underlying principal is tied up for a fixed period of time in a CD, whether you do a 1 year, a 2 year, a 5 year. You know, the longer you do the CD, the higher your interest rate is, but the longer your collateral or your liquidity is tied up. So the benefits here, high contributions, can be used for collateral opportunities, potentially with that same bank for a loan, safe and no loss provisions. Those are your CDs. Now let's go to what many of you may have, which is a money market account, okay? So the money market account, it's getting better, but we're still not where we want to be. Interest rates are still low. Interest is taxed at ordinary income still. Loans still must be negotiated with the bank. There's no guarantee that they're going to loan you money. Call provisions, accounts are subject to creditors, and the liquidity from the loans is not guaranteed. So again, high contributions, collateral safe, no loss provisions, liquidity, use, and control. So really, cash, CDs, and money market all kind of function the same way. It just depends on how much more interest you want to earn from those, but they're still going to be relatively low. We can talk about a savings account, but a savings account has the exact same treatments as all of these others, so I won't spend any more time on that. And let's go to the fixed annuities or the indexed annuities. So this is another vehicle that's being used in the non-qualified space. The good news here is taxes are deferred until withdrawn. Okay, that's good. So tax deferred growth. You don't have to pay that 1099 every year as it earns money. However, there is a tax penalty and surrender charges from the insurance company that issues this for early withdrawals. There are some tax consequences to that. When you do pull money out, the gain is taxed as ordinary income. These are often used to provide consistent retirement income or steady income streams during retirement, preservation of capital strategies. These aren't all bad, but they're not all they're cracked up to be. And they can also provide additional benefits like long-term care. They might have a death benefit component because remember, annuities are issued by life insurance companies. These are actually what you would call a modified endowment contract. Back to that, there's a whole nother lesson on that. Potential benefit of tax-free distributions when you get to withdrawal of basis and deductible contributions if we're using it inside of a qualified plan. However, the benefits, right? Tax deferred growth, high contributions, additional benefits is what I've talked about here, the long-term care, the life insurance, safe, no loss. So we're talking 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 different characteristics, and none of them have been more than 5 so far until we get to something called cash value life insurance. And again, I have other videos about life insurance as an asset class. Do you have a properly structured life insurance policy? All things being equal, it provides tax deferred growth, tax-free distribution, competitive rates of return, high contribution limits, all these additional benefits that we've talked about, long-term care, living benefits, things like that, collateralized opportunities, safe, no loss, guaranteed loan, unstructured loan payments, liquidity use and control. It's got 11 of the 12 characteristics and benefits that you would want in a savings account. Here's some important considerations though. Riders are optional and could come free or could come at no additional cost or for an additional cost. Riders, dividends, once they're paid, become part of the cash value. Interest, once it's paid, becomes part of the cash value. The cash value, when structured properly, grows tax deferred. Loans are a contract feature. They are guaranteed inside of these life insurance policies. Death benefits are paid to beneficiaries income tax free. The cash value deficit during the initial capitalization period talks about the startup fees, expenses, cost of insurance. And I've been through that before. We can talk about that or look at previous videos on how while life insurance has expenses in the early years, it becomes really a cheaper vehicle in the later years. Really about year 8 or 9 is that crossover point where life insurance becomes cheaper than a traditional investment account with a 1% management fee after taxes. And then the disability waiver can pay premiums for your policy if you become uninsured or disabled due to an injury or a sickness. Other characteristics, loan repayments are made at the discretion and at the structure of the policy owner. You have to be responsible for your own repayment of your loan, but you can repay your loan at your rate, at your term, on your schedule, right? That's the power of building a life insurance policy that has banking components to it. And when done properly, distributions can be taken from the policy income tax free. And in most states, the cash value is not subject to creditors. It is a creditor protected asset when built the right way. And obviously death benefits are income tax free. Now we've been through this before, right? I've shown you this. I have a whole nother video on 10-minute lesson on life insurance. And if you want the full video on that, go back and watch that one here. But remember, life insurance, when structured properly, provides 11 of the 12 characteristics that we're looking for in a savings plan. Notice I'm saying savings plan, not investment plan. But in a properly structured savings plan, you can take maximum tax benefits up to the line of what's called a modified endowment contract, which is really what an annuity is, or an IRA, 401k, SEP IRA, starts being taxed and treated like those types of plans. But when you're up to that limit, it's called a maximum efficient contract. And here's where most people fail. And I've talked about this in the other videos before. This line that I'm drawing on right now, or I'm drawing down, is the premium funding line of your policy. Unfortunately, most of the designs that I've seen are not fully maximized for the premiums that you're paying. In other words, You decided on a premium amount and your life insurance agent left a little bit of room there for a couple reasons. One, maybe they thought you were going to grow into the contributions. Let's give them the benefit of the doubt. But the reality is your life insurance agent gave you too big of a policy relative to the premium that you're paying so they could get a higher commission. It's the dirty side of our business, but I'm finding this more and more as you guys are sending me your designs. And so really, you have 11 of the 12 benefits, but they're not being fully maximized. It's not a maximum efficient contract due to the funding and the death benefit being out of balance. When funded properly, when maximized according to the tax structure, according to your premium amount, and having the smallest death benefit possible, that makes life insurance as an asset class one of the very best savings vehicles ever created, and is protected by the Internal Revenue Code and the US tax law. Why not take full advantage of it? See you in the next video. Like, comment, share, subscribe. Thank you.